Would you like to invest in a business that's been making money for more than 2 centuries? Like the idea of sleeping well at night, knowing your investment almost can't lose? Want to collect market-beating dividend income while you sleep well at night? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel. I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a powerhouse financial firm that provides critical services behind the global banking infrastructure. I'm not talking about your local community bank here. This isn't where you deposit your paycheck. This is a global bank that has almost $40 trillion in assets under custody and administration. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Bank of New York Mellon Corp, which appear to be trading at a significant discount today. Bank of New York Mellon Corp, stock ticker BK, is a global financial services company. Founded in 1784, Bank of New York Mellon is now a $36 billion by market cap financial beast that employs almost 50,000 people. The bank provides a range of investment management and financial services in more than 100 markets across 35 countries. Operations are split across 2 principal business segments, investment services and investment management. These 2 segments contain the bank's 7 different business lines: asset servicing, Pershing, issuer services, treasury services, clearance and collateral management, asset management, and wealth management. This is the largest global custody bank in the world, with over $38 trillion in assets under custody and administration. They also have approximately $1.9 trillion in assets under management. The $16.5 billion acquisition of Mellon Financial by Bank of New York in 2007 created the Bank of New York Mellon that now exists. The combined enterprise has morphed into a powerhouse bank that provides critical services behind the global banking infrastructure. In particular, Bank of New York Mellon specializes in institutional services, which includes trade execution, custody, securities lending, and clearance and settlement. A broad array of accounting and administrative services are also available. Through industry consolidation and advancements towards sticky custody assets, Bank of New York Mellon has built an enviable business model focused on scalable, fee-based security servicing and fiduciary businesses. Indeed, fee revenue accounted for 80% of fiscal year 2019 total revenue. The bank's scale and largely fee-based business model positions them well to continue making money and paying out a growing dividend. As it stands, Bank of New York Mellon has increased its dividend for 9 consecutive years, and the 5-year dividend growth rate is 12.3%. This double-digit long-term dividend growth comes on top of a market-beating yield of 3%. That yield, by the way, is 110 basis points higher than the stock's own 5-year average yield. It's worth noting, however, that dividend growth is currently on pause. While the bank has an incredible capability to grow its dividend through thick and thin, they are sometimes prevented from doing so by outside forces. The Federal Reserve stepping in with extreme stress tests and forbidding the increase of bank dividends during the pandemic is an example of that. I expect the dividend to continue growing as soon as it's allowed. In the meantime, the dividend is protected by a very low payout ratio of 27.3%. These dividend metrics are extremely solid across the board. Looking at business growth, Bank of New York Mellon increased its revenue from $13.875 billion in fiscal year 2010 to $15.434 billion in fiscal year 2019. That's a compound annual growth rate of 1.19%. Not terribly impressive. The last decade has been really tough for banks in general due to various factors like low interest rates and tough regulations. While Bank of New York Mellon has a fee-based business based on banking infrastructure, they're still exposed to broader headwinds within banking. Meanwhile, earnings per share grew from $2.06 to $4.51 over this period, which is a compound annual growth rate of 9.1%. Not only is this great, but it's also been almost completely secular. The bank tends to to rack up year-over-year increases in earnings per share like clockwork. There is substantial excess bottom line growth here, which is largely thanks to big buybacks and a healthy expansion in margins. Regarding the buybacks, the bank reduced its outstanding share count by 22% over the last 10 years. Looking forward, CFRA believes that Bank of New York Mellon will compound its earnings per share at an annual rate of 2% over the next 3 years. In my view, this is a pessimistic take on the bank's near-term earnings growth potential. CFRA cites the persistence of low interest rates and overall economic contraction driven by COVID-19 and competitive pressure in the asset servicing space as prime headwinds. On the other hand, diverse business lines, a margin expansion story, and the bank's positioning in a complex regulatory field all work to the company's benefit. Bank of New York Mellon has been resilient throughout the pandemic. Their third quarter fiscal year 2020 report showed revenue down less than 1% year over year. That's mostly because the fee revenue barely budged. Once the US economy starts to move again, so will the bank. Low interest rates hurt the business model, but I think they can do better than 2% earnings per share growth annually from here. The prolific buybacks alone can drive a lot of earnings per share growth, even off of flat revenue. With a very low payout ratio, I believe they'll be capable of easily delivering mid-single digit dividend growth over the long run. Moving over to the balance sheet, the bank has a solid financial position. They have $381.5 billion in total assets against $339.8 billion in total liabilities. The Bank of New York Mellon's long-term senior debt features credit ratings well into investment grade territory. S&P gives it an AA-, Moody's AA2, and Fitch AA. Also consider that Warren Buffett has given his seal of approval to this bank. Berkshire Hathaway Inc. owns a long-time position in Bank of New York Mellon that's currently worth about $3 billion. The bank's profitability is strong and margins have been expanding nicely. Over the last 5 years, the firm has averaged annual net margin of 24.59% and annual return on equity of 10.07%. I see this as a compelling way to play the value in banks without going head over skis into the headwinds from low interest rate. The bank's unique business model and fee-based structure offers a lot to like. I want to reiterate that this company has been around for more than 230 years. One of its co-founders was Alexander Hamilton, one of the founding fathers of the United States. They've more than proven their durability. With global scale, its positioning in banking infrastructure, entrenched relationships around sticky assets, and unique know-how around regulatory matters, the bank does feature competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. An environment with persistently low interest rates is a challenge for the bank. Ongoing downward pressure in fees across banking will likely somewhat stymie the company's growth trajectory. The bank's asset management business faces pressures of its own from the rise of low-cost passive alternatives, and the total economic fallout from the pandemic remains unknown. Any lasting economic scars will affect the bank. Overall, I think this is a quality business with one of the all-time best track records for longevity. At the right valuation, it could be an attractive long-term investment. With the stock down almost 20% year to date, I think the valuation is now quite appealing. The stock is trading hands for a price-to-earnings ratio of 9. That's less than half of the broader market's earnings multiple. It's also way off of the stock's own 5-year average price-to-earnings ratio of 15.3. Keep in mind, I'm not using adjusted earnings here. These are GAAP numbers, making things highly comparable. At 0.9 times book value, it's not even at book here. The price-to-cash flow ratio of 10.7 is below its 3-year average of 12.8. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. That's well below both their 5-year dividend growth rate and their 10-year earnings per share growth rate. But I think the drop is reasonable. This dividend growth rate harkens back to what I wrote earlier about the bank's dividend growth potential from buybacks and the low payout ratio. Those two factors alone can propel plenty of dividend raises. However, moderating bottom line growth from the various challenges will also cap the upside. The bank could certainly do better than this, but I'd rather err on the side of caution. The dividend discount model analysis gives me a fair value of $44.23. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all of the future cash flow it could provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Bank of New York Mellon as a 4-star stock with a fair value estimate of $48. CFRA rates Bank of New York Mellon as a 3-star hold with a 12-month target price of $40. I came out almost exactly in the middle. Averaging the three numbers out gives us a final valuation of $44.08, which would indicate the stock is possibly 8% undervalued. Here's the bottom line, guys. Bank of New York Mellon Corp is a global financial powerhouse with roots that date back to the founding of the United States of America. Their longevity is unmatched. With a market-beating dividend, double-digit long-term dividend growth, a very low payout ratio, and the potential that shares are 8% undervalued, this could be an opportunity to load up on a Buffett-approved stock at a discount. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.